Hello, everyone. This is slightly old news, but about a week or two ago, LCID dropped over 50% in a single day. And some people might not know this, but this actually relates to the first time we have seen a 2x single stock ETF get delisted because the net asset value went negative. In fact, I'm pretty sure it's the first time a fund of this sort, period, has seen negative net asset value and had to delist for that reason. And while this isn't a forecast of Armageddon, I do think it's a really interesting situation given how many of these ETFs are coming into existence these days and how small some of the companies are that are being represented by leveraged ETFs. As of 2025, it's pretty clear that the trend in these funds has been monstrously to the upside, single stock ETFs taking most of the issuance in 2025, and in 2026 it has been more intense than that. And we're now at a point where the amount of single stock ETFs is competing with the amount of broad equity ETFs, and I believe that since this screenshot, that relationship has been overtaken entirely, and it's just a really interesting situation. You might remember something similar in 2018 with XIV, TVIX, and some of the funds that went to zero or were delisted after the VIX rallied over 100% in a single day. And these were representing inverse VIX futures exposure, where something like XIV fell 84% and the product was terminated. In these cases, I don't believe the asset values ever went negative, however, which still keeps the LCID situation a little more unique. Around that time, funds like SPXY simply reduced their leverage exposure from negative 1x to negative 0.5x. And now there's also SVIX, which has 1x exposure, but it also owns long call options, so it can never actually go negative. And while we don't currently have any single stock 3x ETFs, which would make them much easier to go to zero, we do have 3 broader equity ETFs, none of which have gone to zero, though of course they still experience significant leverage decay. But even though we don't have 3x single stock ETFs, 2x is more than enough when some of the individual stocks being represented are incredibly volatile. Like in Tesla's case, since TSLL's inception, Tesla is up and TSLL is down 65%. This reflects exclusively the difference created by the decay of daily rebalancing. And what's really interesting about this specifically is that the assets under management for TSLL have still trended higher over time despite the underlying fund performing horribly in all aspects. So people continue to pile into these things despite them generally not doing very well, at least in a choppier environment. And once again, you can just see this trend continue to expand where every year single stock leveraged ETFs are becoming much more prominent over time since they were legalized in 2022, I believe. And it's just a generally interesting situation, as are the similar ETFs that instead of finding leverage on their underlying, simply sell options against them. You have things like TSLY that look to generate quote unquote income through option selling, though, as I've expressed, these have a lot of issues. Essentially, all these things do is write calls every month and deliver a dividend based on how much they sold the option for, but that doesn't necessarily reflect in performance even when you adjust for those dividends. As you can see with something like QYLD, these things generally do not perform very well. But what's specifically interesting is how many of these ETFs are starting to be tied to every single individually traded company. In Tesla's situation, there are 16 ETFs tied to it. NVIDIA has 14, Strategy has 13, Coinbase, Palantir, and many others have ETFs tied to them as well. And equally interesting is that quantum computing companies that are much smaller in market cap also have ETFs and leveraged ETFs that are being traded on them now. And as long as the demand for these products stays up, these ETFs are going to keep getting released. And I don't know exactly where the limit's going to be, because if people keep buying them, they're going to keep making them. I don't necessarily think this has to forecast doom or anything, but I imagine there will be some interesting repercussions that we have not yet foreseen if we continue to see the assets under management for these funds continue to soar higher. An example of this being how the price of call options in a lot of stocks and ETFs has been effectively artificially dampened because there is so much demand for option selling that they've literally gotten cheaper, which has made these strategies worse. But on the bright side, I suppose it has made buying calls a little bit easier. But in both leveraged and option selling releases. As of the end of 2025, there are 151 option specific related ETFs, 60 of which were released in 2025 alone. And so we're sort of seeing both of these categories of ETFs just explode in issuance and inflows. And I think it's relatively interesting to see. There's even the 1 day till expiration option selling ETF that got released more recently that distributes its dividends weekly for whatever reason. And if you adjust for those dividends, it still performs rather horribly. And obviously, you still have to pay taxes on those dividends. I don't really understand the appetite for these, but there clearly is one given how much they are being released and how many flows are going into them. And what's interesting is you see when volatility picks up, that the ETF flows shift from what's highly leveraged to those with slightly less leverage. And that seems to suggest the type of environment it might take to reduce the appetite for such products. And I don't know when we're going to require such an environment to dampen how intense the situation gets. But it's interesting that we have seen this already in the Liberation Day sell-off, where activity shifted to things like SPY and VOO near the bottom as opposed to their leveraged counterparts. But broadly speaking, the flows into leveraged and inverse funds was still predominantly positive, even amidst the volatility that is generally significantly damaging to both long and short ETFs. And the trend of growth in these products is still growing rapidly, especially into 2025 and 2026, to the point where there's only been about 8 days this year without a new ETF released. I don't have any intense opinions here. I just thought it was an interesting read when I started to look through some of the information on this, and I thought I'd make a video. Anyway, thanks for watching. Like, subscribe. See you next time.